Mambo Limited. Yes. So Mambo Limited, that is September 2021, question number 5B. Question number 2B. September 2021, question number 2B. So Mambo Limited, existing debt to equity is 0.5. So we have here existing. So existing debt to equity is 0.5. All right. And the asset beta is 0.4. So in this case here, we have asset beta, which is the same as beta equity unlevered. Beta equity unlevered, what we shall be calling BEU or unlevered beta equity, they are telling us it is 0.4. Yeah, assets beta is 0.4. Very, very good. Then we are told that the company decides to undergo a financial reconstruction during which it would repurchase its outstanding shares using borrowed debt. This will change its debt to equity ratio to 0.9. So in this case here, this existing, or basically what we are calling before reconstruction. Before reconstruction, this is existing. And then we have here after reconstruction. After doing a capital reconstruction, after reconstruction, what are they telling us? The company decides to undergo a financial reconstruction during which it would repurchase its outstanding shares using borrowed debt. So they're playing around with debt and equity there. So they're playing around actually with debt. This will change its debt to equity ratio to 0.9. So I can see debt to equity ratio here is 0.9. And then they're telling me there that the additional information, the risk-free rate is 6%. All right. The return on the market portfolio is 14%. The firm adopts a 60% payout ratio and expects to generate EPS of 6.0 in the current financial year. The firm generates a net income of 12 million and equity capital is 96 million. Corporation taxes and German is 30%. So they want me to give them the firm's levered equity beta before and after reconstruction. So they want me to give them BEL. Yeah, they want me to give them BEL before reconstruction and the BEL after reconstruction. So they want me to give them beta equity levered BEL. This is what they want me to give them. Yeah, we shall be there. Great. So they want me to give them. This is what they want me to give them. And we have a very, very important formula, ladies and gentlemen. Remember what we have said here is that to get this beta equity levered, we shall take beta equity unlevered into 1 plus debt over equity, but this has to be adjusted for taxation. This has to be tax adjusted. Yeah, this has to be tax adjusted. Yeah, so in this case here, remember beta equity unlevered, which is the asset beta. Before reconstruction, this has been given as 0.4. Now we have everything. We have debt to equity before reconstruction as 0.5. We have everything. Even tax itself, we have it as 0.3. So then ours will be to just substitute. So come here and substitute for us. So our BEL will be equal to BEU, which is what here, 0.4, into 1 plus the debt to equity ratio. Debt over equity before reconstruction here is 0.5 into 0.7. 0.7. Where have I gotten this 0.7 from? It's because from note number 5, corporation tax rate is 30%. 30% is 0.3. And if it is 0.3, then 1 minus 0.3 will be 0.7. Yeah. So is there somebody who can go ahead and give me this beta equity levered before reconstruction? Before reconstruction. And somebody has asked for a favor there. There's a person who has asked for a screenshot there. Please help them. So in this case here, we are getting 0.5 what here? 0.54. We are getting 0.54. And remember, this is before reconstruction. And then they went as to move ahead and they give them bail, but now this time round after reconstruction. After reconstruction, Hamada's model, the same model. You cram this model for just a few months, use the model to pass your exams, and then you forget about this immediately. So to get bail after, we know the formula will still remain the same. It's bail into 1 plus debt over equity into 1 minus tax like that. Into 1 minus tax like that. Yeah. Every other thing will remain the same. Like this bail cannot change. Simply because you're doing reconstruction, bail cannot change. Bail is always constant. So beta equity and levered will always remain the same. It's this assets beta that we have here, which is 0.4. 0.4 into 1 plus, now we expect, now that we had a capital reconstruction, we expect the debt to equity to change. So debt to equity is 0.9 into 1 minus tax. This will also not change, which is 0.7. Please, all of us, take our calculators. Let's practice this body mass thing. So this will be 0.4 times open bracket 1 plus 0.9 times 0.7, you close bracket, we are getting 0. What here? We are getting 0.652, like that. Thank you so much. Thank you so much. All right. So we have answered number 1. Number 1, ladies and gentlemen, has been answered very, very well. The firm's levered equity beta, the BEL, before and after financial reconstruction. And then number 2, they want us to give them cost of equity. Cost of equity is really, really easy for me. I love getting this cost of equity, especially when the examiner tells me to use CPFM. So now we are doing Roman 2. Now we are doing Roman 2. Roman 2, they want us to give them cost of equity using capital assets pricing model. Using capital assets pricing model. Cost of equity using capital assets pricing model. Let me remember very well. CPFM says that there is nobody in this world who is ever getting rich if you don't know how to mix your capital assets. You must have always a mix between risk-free and risky assets. A mix between the two. A mix between the two. That is all about CPFM. Capital assets, ladies and gentlemen, need to mix. Regardless of how really invested you are in the capital markets, for example. You have Safaricom shares, brewery shares, all those things can always be shaken. We have one form of investment that shall never be shaken. We always believe so. Yeah, especially in those old days when governments used to work very well. We have to put into our investment basket what we call risk-free assets. So anytime we talk of CPFM cost of equity, then we must always have some returns from risk-free assets. So we have risk-free assets, and then we have, in this case here, the risky, what here? Risky assets, the returns from the market. Yeah, expected returns from the market portfolio minus risk-free. And now remember, this will give us what we call a risk premium. That return, which is over and above the risk-free rate, it's excess return. But this return comes with a risk. It comes with a risk. So then come here and multiply with BEL. Yeah, beta equity of a levered organization. Yeah, so it will be very, very important for us to just explain this. Very, very important for us to just explain this. Very important for us to explain this, that this RF is risk-free return. ERM is expected market returns. Yeah. Then we have Bell beta equity levered. The levered one, not the levered, the levered one. So like in this question, have they given us these parameters? Oh yes, they have done that. They have done that. If you look at this very well, they have given us in note number 1, they have given us the risk-free rate of return. Yeah, 3 marks for free. Yeah, 3 marks for free. So note number 1, they have given us the risk-free rate is what percentage? Are you able to see from note number 1? Yeah, risk-free rate is what percentage? 6%. Thank you very much. 6%. Plus, how about market returns? They can call them market returns or market portfolio returns. Market portfolio returns, from note number 2, I can see we have 14%. I'm only following this formula, 6%. Multiplied by beta equity over levered before reconstruction. You guys had given me this number. Before, because we are doing here, remember the one we are doing here is before reconstruction. Before reconstruction. You had given me this number. It was 0.54, like that. So then can you kindly take your calculator and punch there 6 plus, open brackets, 14 minus 6, close, times 0.54. In order to get this capital assets pricing model, cost of equity. You can see my capital assets, they are risk-free assets and risky assets. So we are getting 10.32%, if you wish, you write like that. Remember again, a finance student must read the question twice, not just once, no. Remember this question wants me to get cost of equity before reconstructions, using the Bell before reconstruction, and the cost of equity after reconstruction. 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 So come and give me here cost of, yeah, that's what you do. You write here cost of equity after reconstruction. After reconstruction. Reconstruction. Yeah. Cost of equity after reconstruction. Very, very easy. So still they want me to use CPFM. And we know that CPFM, cost of equity, is risk-free plus expected market returns minus risk-free multiplied by now this Bell. Beta equity levered after reconstruction. Everything will remain the same. Risk-free is still 6%. Market returns, they are 14%. Minus risk-free 6% multiplied by our beta equity levered after reconstruction. After reconstruction. After reconstruction. Is there someone who can remind Mwalimu what this Bell after reconstruction was? This Bell, it was 0.652. 0.652. 0.652. Then you can comfortably now go ahead and give us this CPFM cost of equity. Eric Bill is giving me 11.216%. Yeah, 11.216%. So now we are through with Roman 2. Roman 2 is the one that wanted me to give them, ladies and gentlemen, the CPFM cost of equity. Now look at Roman 3. When they want me to analyze the impact of financial reconstruction on the farm's what here? On the farm's low-hanging fruits, yes. On the farm's share price. Farm share price. No problem. That I will get. Because I know this entails share price valuation. They want me to value shares. And the valuing shares, we know in Kenya here, we know in this case here, the person really was talking about shares a lot. Yeah, that you voted in this government name. Now you have shares, you are shareholders, and as such, you must get what? You must get dividends. So anytime you hear about share valuation, always remember Gashagwa. Yeah, Gachagua, who was in the provincial administration, remember we normally say provincial officer equals district officer who has to grow through ranks. So you grow and become a DC, and then you become a PO. So anytime they were asking about provincial officer, this will be DO into 1 plus G, of course, never became even this. He never even became a DC. He really went ahead and became, in this case here, deputy president. Yeah. And if you dare removing, and remember this is just for our case here, this is just for our class here. Don't take like Mwalimu is political. No. I started speaking about these things long time ago, before even these guys in this case here got into headwind. All right. So in this case here, they chase this guy here, then it will be Kenya without government. It will be Kenya without government. So this is really all right. Maybe I've seen your question, I'll be able to address it. So we are saying here that anytime you hear something to do with share valuation, always remember Wama shares. Then remember this PO equals DO who has to grow. All over, in this case here, what here? Kenya without government. The guy may not be a genius, the guy may not be very, very good, but you can see him destabilizing things. Actually, when last time, most of you were telling me that Mwalimu, if I were Dr. William Ruto, I would not have fired Gachagua. It would have been easier to manage Gachagua when he's well within government. That is theirs. That's not ours. Theirs will only help us in this case in remembering this formula. And remember, this is not provincial officer. Remember this, where PO is the current. Current means today. PO means today. Current market price per share. Current market price per share. All right. How about DO? DO is the current dividends per share. Current dividends per share. In this case here, KE is cost of equity. KE is cost of equity. KE is cost of equity. And then we have G, which is the growth rate. G is the growth rate. G is the growth rate. Rono, we shall overcome. We shall overcome. All these people are important. So in this case here, G is the growth rate. Now, remember, here they don't want us to do farm valuation. This is something, ladies and gentlemen, where you always get students confusing. When we are looking at valuation of an organization, here we normally use WACC. Because an organization will have debt and equity. So you shall use WACC. But here we are talking about share valuation. Let's read this question again. What are they telling us, ladies and gentlemen, to do here? Roman 3. Analyze the impact of the financial reconstruction on the firm's share price. So you're doing share valuation, PO. And the PO, ladies and gentlemen, then we shall use here KE. So this question was so nice. My students were very happy with this question, especially part 1 and part 2. But now when it came to part 3, this examiner had something that he had to hide from them. A good examiner can't be just nice to students throughout. Give them number 1, free marks. Low-hanging fruits, number 2. Number 3, in this case, you hide something from them. So you can see in this question, you don't have a problem with DO. Already DO has been given. The current dividends, that has been given. Is there somebody who can be seeing the current dividends in this question? Oh, yes. This is given in note number 3. So in note number 3, they have given me EPS. Out of this EPS, I'll be able to get dividends because they have given me the payout ratio. Note number 3. The firm adopts a 60% payout ratio and expects to generate EPS of what year? 60 in the financial year. So let's get first of all DO. DO are the current dividends paid. Current dividends paid. So of course, this will be equal to EPS times payout ratio times payout ratio. Yeah, you look at how much each shares earned. Yeah, and then you know how much you are paying, right? Yeah, the firm adopts a 60% payout ratio and expects, in this case here, EPS of 6. So then this EPS, we have earned 6. But now the dividends to be paid will be 60%. 60%, which Mildred is giving me a figure of 3.6. 3.6 later. So first of all, this one here, are we in agreement? Eric, I don't know where you got 7.2 from. Eric, I would want to know where you got 7.2 from, or whether you have been able to understand. Yeah, should be 3.6, isn't it? That's really, really good. Yeah, payout ratio, EPS times the payout ratio. Thank you so much. Now, ladies and gentlemen, where now? So I don't have, already I've gotten this. Now I have this. The only thing in this case here that this guy was able, the white, that this person was able to hide from you is the growth rate. Remember, there are two ways of getting growth rates. There are two ways of getting these growth rates, according to Mr. Gordon. Mr. Gordon gave us two methods of getting growth rates. For my case, I will show you the method which is applicable in this question, where G will be equal to BR. G will be equal to BR. This is a very, very important, in this case here, formula that will need you guys to highlight. I believe everybody has been able to buy a highlighter. Yeah, G equals, growth rate equals BR, where B is the retention ratio. B is the retention ratio. In this exam, in this question, can you kindly, in this case here, give me the retention ratio? Retention ratio. Somebody is saying that the board is not clear. From my case, I mean, this is perfect view of board. I don't know how it is for you guys, but for my case, it's perfect. It's very clear. Yeah, for some reason, this board today is very, very clear. Yeah, so it must be a network. So, ladies and gentlemen, you can see out of whatever earnings we have, we are paying 60%. So we retain what percentage here? 40%. So the retention ratio is 40%. Basically 1 minus 0.6. Thank you so much. Thank you so much. Yeah, and then we have this R. R is return on equity. Return on equity, because you're doing share price valuation. Return on equity. Return on equity. So how do we get this return on equity? We can see we equity providers, we can see the profit being realized. Look at note number 4. Look at note number 4. The firm generates a net income of how much? 12 million. With a capital of how much? 96 million. So you've given the firm 96 million and the firm is able to return 12. So return on equity. So what return on what equity? Just that in form of percentage. So you take the return over equity. Basically, you are taking the return over equity. So this return, ladies and gentlemen, in this case here could be net income, PAT, profit after tax. Yeah, so like in this particular case, the return is 12 and the equity investment is 96. If you wish, you can multiply this with 100 and then you give us this figure. That 12 over 96 times 100. So this gives us 12.5%. 12.5%. 12.5%. Now, ladies and gentlemen, once you get this 12.5%, then now you can come and substitute in. Yeah, I like what somebody has told me there. There's a student who has told me one that as we have this music called R&B, I don't know whether there's something called like that. My age, I should not even be knowing whether there are things called like that. But the students will tell you, but when instead of BR, you'll be telling us that this formula is R and B. RB. RB. Maybe that makes them remember. Yeah, which is very, very good. So then go ahead and give us, ladies and gentlemen, this G. So G will be equal to, we can see what B is, isn't it? So you can see B is 0. What here? 0.4, and R happens to be 0.125. So then this one here will end up giving us 5%. 0.05 or 5%, like that. So I'm aware that currently you are doing this cost of capital topic, financing decisions topic. You'll be able to cover this even much better there. You're able to see the two methods there. Yeah, great. Now, having gotten this growth rate, now I can easily give you this PO. PO before the reconstruction and the PO after the reconstruction. Yeah, how do we get the retention ratio? Retention ratio, remember, they gave us, in this particular note number 3, they told us that the payout ratio is 60%. So 60% being paid out. So then what amount are we retaining? We are retaining 40%. Hope you're able to see that. Immaculate. 60% being paid. So the complement, 40%. Yeah, great. So if you're told that the payout ratio is 70%, then the retention will be 30%. Ladies and gentlemen, remember this Gordon's formula in terms of wealth management and the creation is really, really important. Remember the context here was that it doesn't matter how much you are earning as a firm or even as an individual. We have people we have gone to bury. You get somebody who is getting 700,000 shillings a month. But when you go looking for a place to bury them in their local areas, whenever in this case here they die, you realize that these people have not constructed even a manyatta. And that is where now Mr. Gordon went ahead and told us that for you to be able to grow as an individual, out of whatever returns you make, out of whatever your salaries you make, ladies and gentlemen, you must endeavor to retain the highest. Yeah. So retention has to be high from whatever returns you're getting. So retention really is a factor. Retention is a factor. But now whenever you try to bring this kind of a discussion, even in terms of investment speeches here, people tell you that in this economy, there is nothing to be retained. Yeah, that there is nothing to be retained. And when now, depending on what I earn, no. Retaining, saving is a skill that you learn. There are people, even if you give them 500,000, they can't retain. They'll blow everything up like that. There are people like primary school teachers, you give them 40,000 shillings every month, they end up having the best houses, the best cows, like where I come from. When I look at a cow around, I'm able to tell this is a cow that belongs to a teacher. Yeah. So what matters most, ladies and gentlemen, is how much you are able to do what you're to retain. To retain. How much are you able to retain from whatever you're earning. All right. Now we have everything to be able to get to what this examiner is asking us to do, ladies and gentlemen. So this examiner wants us to come here and give them PO before reconstruction. Yeah. So PO before reconstruction. So this will be DO, current dividends, into 1 plus G, all over cost of equity minus G, like that. Now remember, we shall use here KE before. So this KE will be the only one having before tag there. So do they still remember DO is 3.6? 1 minus growth rate, 0.05. All over this I can't remember. We have it KEL before. KEL before. Is there somebody who can remind us this KEL before reconstruction? KEL before reconstruction, 0.54. 0.54. Are you sure KEL before reconstruction it was trying to be that big? Check again. 10.32%, isn't it? 10.32%. So remember it is percent. So it has to be 0.1032 minus 0.05. So here move slowly. Give me the numerator and the denominator. Is it plus or minus? Is it plus or minus? Remember, this is Kenya without government. Kenya without government. Oh, up here. Yeah. Sorry. Thank you for that. Up there. Numerator, yeah. It's plus. Because it is growth rate added, increase. So please go ahead and give me the figure up here, 3.6 times 1.05 body mass. Yeah, so 3.78. 3.78, divide this by, according to metrin, 0.0532. I pronounce that name not in a very, very good way. It is metrin. Yeah, 0.0532. Yeah, so Mildred is giving me a figure of 71.05. So that is the current price per share. If we say, hey, we are not doing any reconstruction, where are we getting the 0.1032 from? Roman 2 question of this question, we were asked here to calculate Roman 2 of this question. They had asked us, in this case here, to calculate Roman 2 of this question. They had asked us to calculate cost of equity before reconstruction, CAPEM cost of equity. And unless you came in a bit late, that is where we got that 10.32. Yeah, 10.32, so which is divided by 100 because percentage to get 0.1032. So I hope that is okay. Then, is this answer correct? 17.05, right? If you're getting 36, please check your arithmetics. Just go slowly. Get the numerator first aside, write the answer, and then you take this, write the answer. And then you divide. Yeah, correct. But HP has not yet told me whether he's okay, whether he's been able to get. So then, how about in this case here, after PO after? Every other thing remain the same apart from this KE, which will be after. Yeah, KE, which will be after. So every other thing will remain the same. So is there somebody who can give me this KE after? KE after. Anybody who is able to give me this KE after? Great, HP, thank you so much. KE after reconstruction, 0.11216. 0.11216 minus that. So this remains. The denominator will have to change. The denominator will have to change. Yeah, 0.06216. Great. 0.06216. So they're giving me a figure of 60.3. Or 60.37. Is it 8177? 81, eh? That's the minimum mwalimu no? 81. But even 6.38 and still accept. I mean, rounding off errors, they're there. 60.811. Good. So then what is the impact? What is the impact of this reconstruction? So first of all, I want to be happy as an investor in the company here. Why? Because I can see that this reconstruction has led to dilution or reduction of the share price. I can see the share price has reduced. Is there somebody who is able to see the reduction? Is it reducing or going up? Remember, before reconstruction, the share price was 70 point something. Now it is coming to 60.81. As an investor, I will not feel happy. This will not be good for me as an investor. So in this case here, yeah, thank you so much, Mildred. So in this case here, we are seeing here, conclusion, that in terms of share price valuation, the stated reconstruction is not healthy. The stated reconstruction It's not good. It's not good. Full stop. Why? The share price is reducing. Is reducing. The share price is reducing from 70 point something to 60.8. The share price is reducing. Investors will not be amused here. So come here and give us the percentage reduction. Percentage reduction. Percentage reduction. So remember, this will be new minus old all over old times 100. So the new price minus the old price, that is before the construction. So the new price here is 60.8 minus what was the old price? The price before the construction. Price before the construction. Price before the construction. Someone who can remind us. Price before the construction. 71.05 over the old 71.05 times 100. So I can see minus something. Yeah, 0.144. 0.144, which is minus 14.4%. So basically you're saying that the price is reducing by a whole 14.4%. That is the impact. Not a good impact at all. Not a good impact at all. Not a good impact at all. So with this kind of a question, assuming it has 8 marks in an exam, are you now comfortable that you can easily pick 6 out of 8? Are you comfortable you can easily pick 6 out of 8? Yeah, we are happy. We shall be able to get a lot of marks there. We shall be able to get a lot of marks there. Yeah, we shall be able to get a lot of marks there. But let me try you. Yeah, let me try you by asking you to do May 2021 question 4C. May 2021 question number 4C. May 2021 question number 4C. This is, absolutely a very, very important area for you in your exam. I'm using the word absolutely because I know it's like absolute. Like it will be there. Yeah, this is very, very important. We just do one question by ourselves and then that will be it. So this is May 2021 question number 4C. May 2021 question number 4C. Let's try that question on our own. Is there a good ninja who can send us the past paper to our WhatsApp group? And I hope there is no bad ninja who is eating something. Yeah, that's a very good finding, Julius. That in this case, yes, debt financing increases in the capital structure, the overall risk will increase. That risk, of course, will be able to do what? To reduce our share price. Great. Mackenzie Limited, yes. Thank you, CEO Rachel. Mackenzie Limited. Let's just try doing the question. Even if you don't get it right, so what? So long as you've tried doing it. Most important thing is you try doing it and always be happy sharing your answers with us on the group. Because the thing here is to be able to identify how was the examiner trying to trick up this question. Because remember the AFM examiner, most of those examiners are sadists. They would want to throw you under the bus. They would want to see you crushed. They would want to see you doing FM 7 times. So in this case here, they would always bring in just some small tricks here and there. And the moment you know how to untwist them, you are done. You are done. Yeah, like Rono who did last sitting, you can see he's confessing like it was a bad paper. But not really. Not really. What I know for advanced financial management, lazima tujifanye watoto wadogo sana, wale watoto wadogo kabisa. Ile ndio ile nasema ukweli kabisa kwamba ile ufalme wa mbinguni ni watoto wadogo. Hii lazima ujitolee. These 2 months imebaki. Hii mimi nakwambia ukweli kabisa. Yeah, lazima tujitolee. Mwalimu akisema tukutane, but I'm happy with this class. Because like last Sunday, 7 a.m., we were over 80 students. Yeah, there's a Sunday actually we came over 100. Yeah. So you see, for one reason or the other, you can tell me that Mwalimu was not able to come in at 7 a.m. Mwalimu, is it possible, for example, the same Sunday, you come in at 10 p.m. and teach the same content? Yeah. I always like forging forward with solutions. But you can't be here saying, like someone was calling me telling Mwalimu, when I paid for this AFM, there were 3 sessions on the timetable. I mean, do you want me to get stuck with 3 sessions on the timetable and then my students fail? No. We want in this case here to invest in you. I would want in this case here to grow with you to serious levels. Even if it means me introducing 5 slots and then I get like 100% people passing, I mean, the better. This is for your good. That Sunday, I'm telling you, I like sports a lot. That Sunday morning, I would go to church even myself very early, and then I go for some sporting activity, like bicycle riding, etc. But I have to dedicate time and to cut. So when you see, for example, yourself in this case, you're being strained of time, but there are family activities on Sunday. Don't think that Mwalimu is an idler. No, I'm also creating time to ensure that we pass this paper. Great. Yeah, I got 8 marks today. Okay, great. And then I haven't yet answered your question. Before to answer your question, I remember there is a question. You see, if you're told in this case here, bread has increased to Kenya shillings 80, yeah? So this is a new price, right? And then the old price, for example, was what here, 70. So how do you get percentage increase or decrease, percentage change? You take the new price minus the old, over the old. So you take in this case here, the new price is 80 here, right? Over the old is 70 divided by the old times 100. So like in this case here, our new PO will be the one after reconstruction, right? And then we have in this case here, the old PO will be the one before reconstruction. So now I hope Nelly have been able to answer your question here. So the percentage change, you take the price after reconstruction minus the price before reconstruction, all over the price before reconstruction. Whatever you get times 100%. Okay. No, actually, if you take my strategy this time around, you'll be surprised. So long as in this case, we just behave like children. When we come until you do a question even on WhatsApp, just create time. I know you guys are senior at your workplaces. I know you guys are married. Most of you have families, which is quite a big calling, not a small calling. I know you are very, very busy at your workplaces. Nevertheless, we have to pass. We don't have, in this case here, 2 terms. In terms of this exam, it has to be 1 term. We go to BDA. We go to BDA. Let me talk a lot after giving you some work. Yeah, inshallah, yes. Just remain silent a little bit. Yeah. So Nelly up there asked about a very, very important question, but let's first of all finish this, and then I make a comment about this question. Yeah, we have to pass. We have to pass. We have 2 more minutes, ladies and gentlemen. Hata kama uelewi, just try to write something. Hata kama unaandika na left hand ama whichever, just write something. Hata kama ni title tu, useme tu before reconstruction, after reconstruction. Try to put in data. Try to write CPFM's formula. Trust you, you'll overcome. Yeah, 9:17, 1 more minute. I know it's not easy. Yeah, great. So according to Rono is saying colleges have a lot of mercy. That examiner wasn't a college because they are merciful. You Rono do this question. Tell me whether the examiner for this question, is he a college in this question here? Is it an easy one? We are overcome. So it's 9:17. Can I go ahead and do it, having tried the question? I know it's a bit heavy. Can I go ahead and do it? So long as you've tried. Ule mwanafunzi mwenye sipendi sana ni mwanafunzi class kama mwenye anakula ugali. Okay, kula ni sawa. Kwa unakula kitu ya kijiko, mchele hivi ni sawa. Lakini sema ukweli kwa umeweka tu ati kila kitu chini unakula ugali. Hiyo ni hatari. Inakuwa international disaster hiyo. Huyo mwanafunzi usitaki yeye kabisa, huyo mwanafunzi. Huyo hapana huyo. Huyo sasa done with them. Okay. Okay. In the interest of time, don't you think I should do the question? Please allow me to do the question, right? Yeah, Julius, let's see. Yeah, like the net. Ah, great. Let me do it. Ah, then great. Good to see Danny. Yeah, let me just do it. I know if you guys got more time, you would have done the question very well. You would have done the question. You would have done the question very, very well. But just allow me to come and tackle it here. Now, this question, the only tricky area was in terms of getting G. Once you know how to get G in these questions, you are done. G, this growth rate. So you know that the growth rate is BR. Yeah. I don't have a problem with B. B is a retention ratio. Have they given me retention ratio, ladies and gentlemen? This they have given me 60%. Thank you very much. 60%. I know where the problem is in terms of this R, the return on equity. Yeah, return on equity. Yeah. So this return on equity, ladies and gentlemen, what do we have over here? So return on equity, of course, here it's PAT all over equity. PAT all over equity. So PAT wasn't given. Profit after tax, not given. But we have earnings per share. So is there someone who can remind us the formula of getting earnings per share? Earnings per share is profits attributable to ordinary shareholders all over number of shares, right in full. Anytime they want you to give us EPS, we normally take PAT all over number of shares, all over number of shares. All right. So if you look at this question, what is the earnings per share from first sentence? From the first sentence, earnings per share ni ngapi? Earnings per share ni ngapi? First sentence. Makazi current earnings per share is how much? Is 6. Which will be equal to PAT over number of ordinary shares. Number of ordinary shares in the question second sentence, they have told me the farmer has in issue 50 million ordinary shares, which have a par value of 20. So I'm talking over number, not value, 50. So therefore, PAT, in our case, it will be what here? It will be 6 times 50 if you cross multiply, which will end up giving us how much here, somebody? 300. Yeah, Valerie is asking a very, very important question. The concept of what your preference shares, great. I'll be able to touch on that, especially on the front of Altman's Z-score. Yeah, so we have 300 here. Great. So we have 300 here. So up to here, ladies and gentlemen, are you able to follow? Yeah, up to here, are you able to follow somehow? Yeah, so 300. So let's get back and define the return on equity. So then return on equity will be equal to the PAT that you have here, 300. All of our share capital, equity share capital, remember number of shares are 50, and the par value, they have given me a figure of what here? The par value, they have given me a figure there. They have given me a par value of 20 each. It doesn't stop there. Remember, equity capital, we are looking at our share capital and any reserves which belong to equity holders. Any reserves that belong to equity holders. So they're telling us that the firm's total revenue and the capital reserves amounted to 500. So plus 500. I mean, how do you expect, honestly, a student to get to know how to do this? Are these students, in this case, here born to suffer? No. With little practice here and there, they'll be able to know these things. Yeah, they'll be able to know these things. Yeah, they'll be able to know these things. So return on equity, how much do we have there? Of course, the final answer, whatever you get. So this one here will be 300 over 1,500 times 100. 0.2 or 20%. 20%. Honestly speaking, in an exam, would have you gotten this growth rate? Because the moment you get growth rate, then you're gotten the entire question. In an exam, would have you thought of calculating this growth rate this way? No. And remember, even what you have gotten is ROE, return on equity. You still have to come and give us the G, which is BR. B, you guys gave me 0.6 times this 0.2. Yeah, which will end up giving us what growth rate? I hope I sound okay. Yeah, 12%. Quite a high growth rate. 12%. A very high growth rate. So, and that is why I don't want you even to be doing extra questions. I would just want you always to keep on asking yourselves, if, for example, I was to be given a chance of doing this question, if I was to be asked this kind of a question again, will I be able to redo it in an exam? You keep on repeating the questions that we do in class. You can never go wrong. You can never go wrong. So now, having gotten this, I'm so sure now you guys can make now moves, great moves now. You can make great moves. Look at what the question is asking. They want us to give them the firm, returns on equity before and after financial reconstruction. The firm's return on equity before and after the financial reconstruction will remain the same. Required, evaluate the impact of the financial reconstruction on the firm's what year share price. Now, ladies and gentlemen, here what I will do pretty fast, I will look at the beta given. What kind of beta has this examiner given me? This examiner has given me assets beta. And if the examiner has given me assets beta, then the first thing that I would want to do is to get beta equity levered using Hamada's model. So change assets beta, change assets beta to BEL, beta equity levered, using Hamada's model. Using Hamada's model. Highlight that. So we know Hamada's model BEL equals BEU into 1 plus debt over equity into 1 minus tax like that. So give me this BEL before reconstruction. Before reconstruction. So are you able to see beta equity and levered? Beta equity and levered is the same as beta equity assets or beta assets. Are you able to see it somewhere, ladies and gentlemen? Beta assets. Yeah, I can see Shayla there. Great. So beta assets is 0.9 into 1 plus debt to equity before reconstruction. Before reconstruction, yeah, which will result in a debt equity rate change from 0.45 to 0.2. So the old one is 0.45. Before the change, it was 0.45 years, 0.45. Times, are you able to see the rate of tax there? Yeah, corporation tax is 30%. So 1 minus T is 0.7. 1 minus T is 0.7. So please go ahead and give me an answer, final answer, as the BEL before reconstruction. Yeah, HP is giving me a figure of 1.1, 1.1835. Remember, KEL is a natural brother to BEL. Once you've gotten, in this case here, this BEL, go ahead and give me KEL. Yeah, using CPFM. KEL, cost of equity of the levered firm. Yeah, KEL is a brother to BEL. Yeah, and we know the formula. Yeah. So in this case here, CPFM, it is risk-free plus returns on the market minus risk-free multiplied by the brother, BEL. And remember, you're getting this before reconstruction. Before reconstruction. Yeah. So in this case here, risk-free. Are you able to see the risk-free in the question? It is 8% from note number 1. Market returns from note number 2. The expected rate of return on the market portfolio is 18%. Multiply by the bell before 1.1835. Wewe mwenye unakula ugali nipatie answer hapa. Pega kila kitu chini kwanza nipatie answer hapa. Yeah, Shane is giving me 19.8 something. And market the same, all of them 19.84, 85. Right, yours. Yeah, great. Great. So then having gotten this, I will not stop there. Remember this time around, the examiner has not asked me to get like beta equity before and after. No, I can do everything before until I finish. I will do everything before till to the very end. So come and give us PO before. So I know PO before, it is DO into 1 plus G all over Kenya minus government. All over Kenya minus government. So PO before equals DO into 1 plus G all over KE minus government, like that. Yeah, abracadabra. So is there someone who is able to see our DO? Yeah. DO is a current dividend. Anybody who is able to see our DO in this question? It will come from EPS and payout ratio. Yeah. 2.4, isn't it? 2.4. Because they have told us, DO, this will be equal to EPS times payout ratio, of which EPS from sentence number 1, it is 6 times, in this case here, payout ratio. The payout ratio, they have told us retention ratio is 60. Retention, what they're retaining is 60. So then they are paying 40. So 6 times 40%, which will end up giving us 2.4 like that. That is what we are using as our DO into 1 plus G. So are you able to see the growth rate? Are you able to see the growth rate? Remember, it is growth rate. Growth rate. Already we have it. It is going to be constant. It is 12%. 12% all over KE. KE that we have now somewhere here. Here, always use the points. Use the points. 0.1984 minus 0.0 minus 0.12. Sorry for that. Sasa hapa tu ni patience tu. Maisha nataka patience hapa. Wende upate numerator, useme 2.4 times 1.12 equals, andika answer yake, all over this subtracted. Andika answer yake, alafu give me the final answer now. Give me the final answer. Give me the final answer. Metrin, Sarah. Final answer. Eric Bill has been very consistent. Mildred has been very, very consistent. She's very, very good. Which is really, really good. Really, really good. Really, 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 really good. So Brenda Otieno, 34.24. This is Barbara. 34.29. 34.29 is the price. 34.29 is the price. Thank you very much. 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 We haven't yet finished the question. We still have to go through the whole process and give them the PO now after the construction. When the D over E, when the D over E equals who? When the D over E equals 0.2. Remember the debt to equity is changing, Yeah, 0.2. Yeah. So first, give us the firstborn. The bigger brother is Bell. So we know that Bell equals Bell into 1 plus debt over equity into 1 minus tax, like that. And you'll have to do the whole thing again, or through the whole process. So then we have Bell. BEU, in this case here, BEU, that will always remain the same. Beta assets. Magda, she's giving me an answer there, 1 point. Oh, you already have the final answer. If I work with that final answer, I'm so sure somebody will feel very bad. Yeah. Into 1 plus 0.2 times this will be 0.7. So can you kindly give me this bell? I'm being told it's 1.026. Yeah, 1.026. I think that is very good, isn't it? So after that, now you go for the second bond. So the second bond is Kel. Yeah. Go for Kel. Yeah. So Kel, in this case, remember we are using CPFM. Yeah. So CPFM, it is risk-free into ERM, like that, into our bigger brother, Bell. Yeah. Risk-free remains 8% or 0.08 plus ERM is 18, sorry. 18 minus risk-free, which is 8, multiplied by our bell of 1.026. Great. So according to CEO ratio, we have 18.26. 18.26. Thank you so much. Thank you so much. So now after Bell and Kel, now automatically we go to the father, isn't it? The father is Gashagwa. The father is Gashagwa. Yeah. The father now is Gashagwa PO. Give us PO, which will be equal to DO into 1 plus G all over Kenya without government. Kenya without government. Already they have an answer. So what is DO? What is DO somebody? What is DO somebody? What is DO somebody? The DO. Please give us the DO first of all. 2.4. We had already gotten this. 2.4. Into 1 plus growth rate. What is the growth rate? Remember growth rate, they told us growth rate remain the same. 0.12. 0.12 all over Kenya. So remember this is care after reconstruction. Remember this is after reconstruction, and this care is 0.1826 minus 0.12. Kupata final answer hapo sio rahisi, lakini we shall pray. Yeah, you simply go and say 2.4 times into 1.12 all over 0.1826 minus 0.12. What are we getting, ladies and gentlemen, here? Caroline Benvolet, they're telling me, Mwalimu, this is 42.9, 42.94. Is that okay, ladies and gentlemen? Yeah, and this is really a good reconstruction. A reconstruction that leads to an increase in price, share price, it's a good reconstruction. I would recommend it as a financial consultant. I would recommend this one here. So are you able to give me the impact in form of percentage? Because they wanted to evaluate the impact. Impact. Is there somebody? Yeah, sure bet, yes. Sure bet. Sure bet. But now remember, you must again, Davin, please repeat immediately. Repeat this immediately. Yeah, you put the solution aside there, then you repeat. That will be very good. Yeah, so 8.6% increase. The impact is 8. Benevolent has given me a different thing. We shall overcome. Remember, it has always to be in form of percentage. Impact must always be measured in form of percentage. Ruth Atieno is saying 25% or 24 point something. Great. So percentage impact. It's new minus old over old times 100. Times 100. So then we have the new. The new is the one after the construction, right? Which is 42.94 minus the old one before, 34.29 divided by 34.29 times 100, like that. Times 100, like that. Ooh. Ooh. 24.3% increase. 24.3% increase in share price, which is very good. We recommend the reconstruction to be done. So if you rate like that, out of the number of marks given, if there are 5, the examiner can easily end up giving you 6 out of 5. 6 out of 5. Yeah, 25 point something, isn't it? Great. 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 Now, ladies and gentlemen, as an experienced examiner myself, of course, I used to be an examiner in those old days. Now I'm no longer an examiner. I became so busy with audit. Initially, I never used to do a lot of big audits. Nowadays, I'm involved in a lot of external audits. Yeah, so I can't get time really to give past them. But of course, having in this case here understood that now students are now very good in terms of getting these share valuations. As an examiner now come this semester, I will not test them on this impact on share valuation. I have to twist them. Yeah, you must twist them. Remember this particular candidate exams, ladies and gentlemen, is just like football. Yeah, Man U, and then we have Arsenal on this other side. Do you think these two teams here can be best of friends? No, it's a tug of war. Yeah, it's a tug of war. So an examiner is here, the students are on the other side. There's no way you can be best of friends. That I give you like say 5 clear through pass questions and then you get 90% all of you. Then I'd be seen like to be a stupid examiner. Yeah. So the very best is to have the curve normal. 50% pass, 50% in this case here failed. Normalize things like that. But if in this case here were to be a sadist, now we'll twist this question this way. This is how we'll twist this question. And this is the last one we're doing for this topic. Let's look at April 2022, question number 4D. April 2022, question number 4D. Yeah, how do we get this growth rate? Remember to get the growth rate, ladies and gentlemen, how do we get this growth rate? I wish you asked immediately before I wrapped, but nevertheless, we shall overcome. So remember, growth rate is BI. Retention ratio, in this question, the payout ratio, no, they give me retention ratio in this question. Directly, they give me retention ratio of 60%. But you see, this is return on equity, which will not be given by your examiner. You must look for it. And how do we get this return on equity? It is profit after tax divided by what year? Equity itself. Yeah. Divided by equity itself like that. Yeah. And I'm so sure this is, equity is share capital plus any reserves, capital reserves. Yeah. How do we get our share capital? They gave us number of shares 50, and each share has a value of 20. Per value is 20. And then we have reserves of 500. Yeah. So this gave us 1,500. Yeah. And then also this one was hidden. To get this PAT, ladies and gentlemen, we have to use this formula of EPS, which is PAT over number of shares. Yeah. So in this case here, this EPS is given us 6. PAT we don't know, but we have number of shares here which are 50. Therefore, PAT will be 50 times 6, which is 300, like that. 300, like that. Then we're able to take 300 divided by 1,500. Whatever answer we got, we plug it in here. I hope that is helpful somehow, and you can now use this to, yeah, we're doing this April 2022. April 2022, question number 4D. The wonder. Are we there, ladies and gentlemen? Are we there? Viwanda Limited. Viwanda Limited. Viwanda Limited. April 2022. April 2022. April 2022. Viwanda Limited. Viwanda Manufacturers Limited. April 2022. Question number 4. D. Question number 4D. Question number 4D. Viwanda Manufacturers Limited, current EPS is 5. That's how they always start. The company has an asset beta of 0.9 and adopts a 40% dividend payout ratio as its dividends policy. The risk-free rate of return is 5% and the equity market risk premium is 10%. The management of Viwanda Manufacturers Limited intends to undertake a financial reconstruction which will result in a debt to equity ratio from 0.15 to 0.3. Debt is considered to be risk-free. Corporation tax applicable is 30%. Show the impact not on the price, but on the famous WACCA, WACC. Show the impact of the financial reconstruction on the WACC of the firm. Do you think you can get this question correctly? Maybe just a small hint. To get WACC, so we have your weight of equity, cost of equity, weight of debt, cost of debt, tax adjusted. Right, 12. AD. Adjusted for tax. Adjusted for taxation. So then that would mean that I just go through the same processes. Yeah. Get, in this case here, Bell, get Kel. The only step that I'll not be able to go through is the one of PO. I don't need that one. Yeah. Once I have Kel, I have KD, because KD, they have told me that debt is considered to be risk-free. So basically KD equals risk-free. KD equals risk-free, which in this case here, they've given me the risk-free rate. They've given me the risk-free rate. Have they given me risk-free rate somewhere? Yeah, 5%. So I'm able to calculate the Kel. Of course, Bell, Kel, get the weights, get this WACC. And then I see the impact. Good financial reconstructions should reduce my cost of capital. I expect, if I'm right, if I will do it very well, if I would recommend reconstruction, then the reconstruction will be reducing my cost of capital. Yeah. So, ladies and gentlemen, do you think it is good I leave this question with you as an assignment? Especially for those students who are looking at me with many eyes. They're seeing me in multiples. Somebody must have gone to their work today at 5 a.m. and they're still with me here. They're really struggling. Yeah. So at least if I've been able to make them understand even one question, that I'm a good teacher. But if I prolong quite a lot, I'll become a bad teacher. Yeah. Great. Red eyes. Great. We shall overcome. We shall overcome. Nelly, yes. Did you come for it, Nelly? Did you come for it? You need to come for it. You need to come for it. Or you organize. You can talk to this lady here. She'll be able to get back to me regarding on what you would wish. If you're around here, you pick it for free. Yeah. The other students, of course, need to buy it at 1,000 Kenya shillings. 1,000 Kenya shillings. All right. Yeah. So Nelly, you can chat with me. I give you authorization. It will be very easy. We finish that today. Yeah. Great. So are you guys, is there anybody who has been attending my AI classes? Anybody who has been attending my AI for accountants and auditors classes? Don't tell me nobody. I mean, there must be somebody. AI is a big thing. Yeah, great. I hope you have started using that knowledge at your workplace. I hope you have started using that knowledge at your workplace. I want you to run with this big ball called AI as fast as possible. Yeah, So ensure that you're using that knowledge as fast as possible to make financial statements, etc. The other ninjas, of course, who are doing many subjects. The ones who are doing like 3 subjects in August or even 4, you shall do your AI later. For now, you concentrate here. But if you are doing like AFM alone, yeah, I will do intake every month. Actually, what I've done, I've brought in strategic investors and we have opened a new college just for AI alone. Yeah, it's called in this case here ACCA. Yeah, African College of Artificial Intelligence. Yeah, we're going to launch it in a big way. You know, I'm always, in this case, always ahead of the game, right? Yeah, I've seen there's a big gap here. Actually, not in Kenya alone, but Africa, big gap here. Yeah, and of course, now within this, we shall be able to offer various AI courses, not just for accountants. Yeah, yeah. For example, how do you write a business plan, an effective business plan using this AI? Yeah, these technical financial proposals using AI. So please be on the WhatsApp for this. But before then, of course, we're only looking at this AI for accountants as RCM College. Great. It was wonderful, great. Yeah, you can see somebody already has used to this. External audit firm, it's we call ourselves Aura and Co. Yeah, we are based at Haven Court, Westlands, yeah, Westlands, along Wayaki Way. Wayaki Way, you come there, you'll be able to find me in person. And during the day, I do audit 100%. Audit and taxation. Yeah, like on Wednesday. Yeah, we were in Mombasa representing a big client. Yeah, over KRA matters. Yeah, yeah, that's what we do. But of course, don't call me for a KRA matter if you're not that kind of a person who believes in accountants. First of all, you must be having an accountant. You must be having a system. Yeah, so that when we are looking at KRA issues, yeah, we are looking at your books. You must be having some form of books. Yeah. If you have some form of, even if they're not 100% complete, it becomes very easy for us to argue your case with KRA. But if you come and tell me that now this is a bank statement, number one, I know if you don't have internal control systems, you're not able to produce your own financial reports, you can't pay me handsomely as your consultant. Yeah, you don't respect accountants, first of all. Yeah, so that is it. Otherwise, thank you so much. We shall overcome. Chai ya kuja always, chewezi kosa. Evelyn, yes, we can always discuss. We can always discuss about attachment, not jobs, but attachments. Attachments, yeah, here. Yeah, that's okay. So thank you so much. Be blessed. See you on Sunday at exactly 7 a.m. I hope all of you will be there. Because now 7 a.m., I'm going to do great things here regarding this and something very nice. Don't miss. See you on Sunday at 7 a.m. Bye. Yeah, good night, ladies and gentlemen. See you on Sunday.